What if you could predict the next crypto crash before it happens? Or identify the exact bottom before prices explode upward again? Crypto millionaires aren't just lucky. They understand market cycles and use them to buy when others are terrified and sell when everyone's celebrating. Today, we're decoding the predictable patterns that drive cryptocurrency prices. These patterns have repeated for over a decade, creating both fortunes and financial ruin. Stay until the end for 3 specific signals that have predicted the last 3 major Bitcoin tops. Signals that might be forming again right now. Let's dive into the crypto market cycles that could determine your financial future. What are market cycles? Crypto markets don't move randomly. They follow distinct emotional cycles that repeat with remarkable consistency. These cycles aren't unique to crypto. All financial markets show similar patterns. But crypto cycles are more extreme and compressed, often completing in 2 to 4 years what stock markets might take decades to experience. A complete crypto market cycle typically includes 4 phases. The accumulation phase when prices are low and sentiment is negative. The markup phase when prices steadily rise and optimism returns. The distribution phase when prices reach euphoric levels and early buyers sell to newcomers. The markdown phase when prices collapse and panic spreads. Understanding which phase we're in helps you make rational decisions while others act emotionally. Phase 1. Accumulation. The accumulation phase starts after a brutal bear market when prices have crashed 80% or more from their highs. Media headlines declare crypto dead. Public interest vanishes. Your friends no longer talk about Bitcoin. Trading volume dries up. Only true believers remain. This is precisely when smart money begins accumulating. Institutional investors, venture capitalists, and experienced traders recognize value while others see only disaster. Bitcoin's price traded sideways between $200 to $300 throughout 2015 after crashing from over $1,100. Few wanted to touch it. Media had written hundreds of Bitcoin obituaries. Many early adopters gave up. Yet this accumulation period set the foundation for the massive bull run that followed. Key indicators of the accumulation phase. Price stabilizes after a long downtrend. Trading volume remains low but consistent. Negative news no longer drives prices lower. Technical improvements continue despite price depression. Phase 2. Markup. The markup phase begins subtly. Prices start rising without major news or catalyst. The initial rise is often dismissed as a dead cat bounce, a temporary recovery before another fall. But the rise continues. Technical indicators turn positive. Moving averages cross. Trading volume increases. The crypto begins outperforming other assets. Early in this phase, only experienced investors notice the shift. By the middle stage, positive headlines return. By the late markup phase, mainstream interest reawakens. Bitcoin entered its markup phase in late 2016, crossing $1,000 again in early 2017. By mid-2017, prices exceeded $5,000, then $10,000 by November. 3 identifiable stages occur in the markup phase. The stealth phase when only insiders and technical analysts notice the trend change. The awareness phase when the media begins covering the price rise and early retail investors return. The mania phase when prices go parabolic, everyone's talking about crypto, and your taxi driver gives you investment advice. Phase 3. Distribution. The distribution phase represents peak euphoria and maximum danger. Prices rise parabolically, often doubling in weeks or even days. Every prediction seems too conservative. Social media celebrates overnight crypto millionaires. New investors rush in, terrified of missing out. Meanwhile, experienced investors who accumulated during the bear market start selling. This distribution transfers assets from strong hands to weak hands, from patient investors to FOMO-driven newcomers. Bitcoin reached this phase in December 2017, shooting from $10,000 to nearly $20,000 in just 19 days. Coinbase became the #1 downloaded app. Celebrities launched cryptocurrency projects. Everyone was a genius. Key warning signs of the distribution phase. Price increases become nearly vertical on charts. Mainstream media coverage turns euphoric. Social media is dominated by price speculation. Projects with little substance see massive gains. This time is different becomes a common phrase. Phase 4. Markdown. The markdown phase arrives suddenly and violently. A series of sharp drops and partial recoveries creates a stair-step pattern downward. Each bounce convinces some that the dip is temporary. Buy the dip becomes a painful lesson as each recovery fails and new lows are reached. The same media that celebrated crypto now declares it a scam or bubble. Public interest collapses. Weak hands who bought near the top panic sell at massive losses. Bitcoin's 2018 markdown was brutal. From $20,000, it fell to $6,000, briefly recovered to $11,000, then continued falling to $3,200 by December 2018, an 84% drop from the peak. 3 stages typically appear in the markdown phase. The denial stage, when investors believe the drop is just a correction before higher prices. The fear stage, when the downtrend becomes undeniable and panic selling accelerates. The capitulation stage, when even long-term believers give up hope and sell at any price just to exit. The psychological cycle.